Everyone, happy Thursday, March 13th. It's about 11:45 in the morning on the West Coast, and it's time for another market update. As I'm sure you saw the news, it's been a crazy week in the markets with tariffs taking effect. The market's trying to figure out how that's going to affect our economy and so forth. We also got some big inflation reports and a big jobs report last Friday. So let's get right into it so I can make sure I can cover this all. There's a lot to cover, so this might be a little bit longer than usual. First thing, like I said, going back to last Friday, we got the big February BLS jobs report. This is the biggest market mover, the one that affects our rates the most and whatnot. Hasn't been the friendliest report to us the last couple of years. Tends to come out higher than expectations, and then later on they come back and say, "Hey, we were wrong. It wasn't that high." But at that point, the damage is done. So this is for February of this year. The business establishment surveys where they get some data from the job or from the businesses, and then using some math, exploit those numbers out and come up with their numbers. Seasonally adjusted jobs created in February, they had at 151,000 jobs. Expectations was 160,000 jobs. So that was good to see. Of those 151,000 jobs, 136,000 of them came from the birth death model. Keep in mind, the birth death model is where they try to estimate how many jobs were created in February by new businesses opening and how many jobs were lost in February by old businesses closing. They had that number at 136,000, almost all of the jobs created, where the ADP, which is actually coming from private payroll data, I had that at negative 12,000. So this number will probably be revised down later. This is probably where a lot of their negative revisions are coming from. The next part about this that was pretty good for us has to do with wage inflation. So wages inflation is, the more we make, it tends to be the more we spend. Markets don't like that. I'm all for us making more money, but the more we make, we tend to spend more as Americans, which passes along to consumer inflation. We don't want inflation right now. So it's good to see that, average weekly earnings actually dropped from a revised 3.6 to 3.4%. And again, anything that shows that wage inflation is moderating or dropping, it tends to be good for us. Next part of this BLS jobs report that we get is the household survey. So this is where they actually call people looking for jobs and ask them what's going on, basically. And that showed that jobs lost were about 588,000 for the month. The total labor force dropped by 385,000. But keep in mind, some of those people just didn't apply for a job in that period of time, so they no longer get counted. And the participation rate dropped a little bit. So that basically made the unemployment rate, the U3, the one that we see on the news and stuff, jump from 4% to 4.1%, where it was expected to stay at 4. So that was good to see. And then the U6 number, which basically is the all-encompassing number. So they throw everybody back in here, and that jumped from 7.5 to 8%, which is the highest since October 2021. So that's probably a better, indicator of what our actual unemployment is in this country. And that's, again, the highest since October 2021. So overall, a pretty good jobs report for us. Markets received it pretty well. Next thing we got was the January JOLTS report, so job openings report. Again, a little dated compared to the February data. This is for January. They're a little late with this. It came in from a revised, a little higher than expectation, revised 7.5 last month to a 7.7 this month, 7.7 million. Leisure hospitality dropped by about 50,000 jobs. Retail trade jumped by 143,000 jobs, which is a little weird this time of year. Traditionally, these drop this time of year with the holidays being over. So maybe this will get revised later, which kind of leads me into their revisions. The JOLTS report came out with all their revisions for 2024. And not shockingly, they revised all their numbers down across the board quite a bit. So if you take the average, I think it's about 360,000 less job openings per month on average in 2024 than was originally reported. So like I said earlier, it would have been really nice if we got this data right the first time, because the markets would have reacted differently. This month of June, 500,000 less job openings than was reported. Markets would, rates would have liked that better. So it's disappointing we don't get the correct data to begin with, but I guess at least we're getting the correct data now. Next thing we get. So we got big inflation data this week, the February CPI, consumer inflation, and February PPI, which is producer wholesale inflation. So overall, this was really good data, but there's been kind of a muted reaction, and basically because of tariffs and how this data might feed into reports later in the month and so forth. So looking at the actual data, though, like I said, CPI was supposed to come in about plus 0.3% month over month, came in at plus 0.2. Year over year dropped from 3 to 2.8%, which was great to see. Food costs, mainly eggs. Eggs were up 10.4% month over month, up almost 60% year over year. I'm sure we've all seen that on the news. Eggs are almost as valuable as gold, it seems like these days. But eggs were a big part of the headline number jumping up. And then the core number, which takes out all the food and energy costs, that dropped too. That was supposed to come in about 0.3, came in at 0.2%. The year over year dropped from 3.3 to 3.1%. So all good news there. Shelter is still the biggest, raise here, but shelter is starting to drop. It's not necessarily where we'd like it. Right here, core CPI. If we just went off of Zillow and apartment list, like an aggregate of the real time data, our core number would be closer to 1.95%, where right now we're at the core is still at 3.1%. So, a lot better if we can catch up here, but we know it's heading that direction. Airline fares helped us this last month. Motor vehicle insurance wasn't too bad. That was good to see. So basically everything else in core is just at 0.15%. It's all about shelter right now, and that's getting better, but still higher than it should be. Next thing we got, like I said, was the PPI data. So this is, wholesale inflation. This is, the people producing these goods that we go with. And this came in really low. This came in at month over month. The headline number was flat when it was supposed to go up by 0.3%. And the core number month over month dropped. It was negative 0.1% when it was supposed to go up by 0.2%. So that, year over year, that brings it to, I think, 2.4% on the, 3.2% on the headline, and about 3.4% year over year. Here it is in graph form. So, again, generally, that's good to see, because if the cost to produce these goods has gone down, you would hope that gets passed on to us as consumers. So good to see both the CPI and PPI came in our favor there. Initial jobless claims. So this again is still really low. Expectation was 226,000 new unemployment claims last week, came in at 220,000. Haven't seen a big jump there. Waiting for that big jump. If that big jump happens, that might be our first indication that things are changing in the labor market quickly. Next thing. So basically the biggest thing this week, like I said, it was tariffs. And there's two different sides of tariffs. I'm not going to get into, I'm not an economist. There's, time will tell how these will all go into play, but there's two different takes on the tariffs right now and how they're going to affect our economy. One is higher prices. Higher prices is inflationary. Mortgage rates don't like that. We don't want that. But the opposite side of things is, right now, the way that at least the mortgage market and the bond market is taking a lot of these tariffs is not necessarily the higher prices side of things, but the economic slowdown side of things. So basically the markets are thinking, hey, these tariffs are going to slow down our economy, possibly cause a recession. That's actually good for mortgage rates. So, real quick, I probably will show these charts multiple times over the next couple months, but keep in mind home values during a recession. This is why, we're not necessarily, the recession word doesn't necessarily scare us in the mortgage market, because home values tend to do well. So all these shaded areas are when there was a recession. And as you can see, for almost every recession, values went up during it, and then afterwards continued to go up. So the only time they dropped was in the housing crash in 2008. And keep in mind that recession was caused by housing. That was, we made a lot of changes to the industry since then. There's a lot more qualified buyers, a lot less housing available, things like that. So there's a lot of reasons why we're not, 2008. But just keep in mind, every other recession besides that one that was caused by housing, home values have performed well. And the reason they perform well is generally mortgage rates come down. Again, the recessions are the shaded areas. As you can see, generally going into it, rates are coming up, and that recession causes rates to come down and continue to come down. And that's the graph form, but just to show you the numbers, 1980, rates fell by 4.25% during the recession, 81 by 5%, 91, 2.25%, 2001, a little bit less, up to 0.63, 2008, 1.13, and then in 2020, during the COVID recession, about 1% rates dropped. So overall, again, recession is not bad for mortgage rates. Mortgage rates tend to get better. Recessions tend to be not bad for home values. Home values tend to get better. So, overall, that, the tariffs, with the economic slowdown, our side of things have actually taken that pretty well. So it'll be interesting. Like I said, we don't know what's going to happen over the next couple of months. We'll have to see all these policies take effect in the long-term effects. But right now, overall, it's been at least, instead of it looking as inflationary, we've looked at it as more of a recessionary thing. So where does that leave us? Average 30-year conventionals jumped a little tiny bit from 6.79 to 6.82. So staying kind of flat. We've been really close to this 6.8, 6.75 number for a couple of weeks now, which is good to see. We've established, underneath the 7 number, but again, it'd be nice to see this start to come down a little bit more. And then next week is the big Fed meeting on the 19th. Right now, it's 99% chance, according to the markets, that they do not do anything. They pause rates. 1% chance that they cut rates. So Not going to cut rates, it seems like. The big thing from that meeting will be seeing what they say afterwards at their press conference and how they answer questions, just to get an indication of maybe where they're headed next. So overall, busy week, not a bad week for us, but a crazy week with all this tariff stuff. So everybody's got to be patient to see kind of how this stuff transpires. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.